we'll now get into a little bit into nuts and bolts of the industry's future from here. One statistic that we're going to be playing out throughout the evening is the number of mutual fund investors that we have in the industry today is 4 crore. The number of stock market investors, 8 crore. We couldn't get the exact number of FD investors, but we have the FD term accounts, the number of term deposit accounts, which are about 25 crores. So in a very crude way, to assume that one person has 2 fixed deposits, that pegs the number of fixed deposit investors to about 13 crore or so. But it's a very crude assumption, and I agree with that. When we are talking about an industry like mutual funds, which is so well regulated, which has come up so well, and we've even heard, good things about the regulator now patting the back of the industry, saying that hamara beta, bada beta hai, and it's done so well. Why is the number of investors in mutual funds so low at 4 crores when it should have been ideally at 8 crores or 10 crores? So when we asked around, when we speak to experts like you all, the feedback that we get is that, people have some kind of a perception issue about the mutual funds. Either the mutual funds are too risky, or, there is a trust deficit at different points in time, or, if you want to create wealth, you need to go to the stock markets, etc. Radhika, you're okay. Oh, I thought you were cheating.
Oh, no, I'm not cheating.
So, we are going to sort of address some of these perception issues and taking the industry's views as to how they're going to battle this perception, as they're going to be taking on more and more investors in this journey from 4 crore to 20 crore investors. Swarup, let me open with you. One perception, and a very, very common perception, and what Bala also attributed that, is that so many investors who have come in the stock markets in the last 3 or 4 years. You can see the number of demat accounts which have opened with such velocity. They were opened during and after COVID times. Somewhere there is a perception that if you want to grow wealth, it's better to go to the stock markets rather than go to the mutual funds. It's a very, very common perception. And so how is the mutual fund industry going to battle this perception and give better experience to investors?
Kayezad, thank you for having me. Sorry, I'll have to be the devil's advocate on this one. I think we have to change if we have to battle this. We are very judgmental. If you ask me, opening a demat account is wrong, direct business is wrong, F&O mein paisa lose ho karta hai, Dream 11 is a bad thing. See, these are financial assets, right? Money will go wherever it goes. Whether it comes to us or not is the biggest question. Our job is now to cater to a very different demography. Let's look at 2 data points. One is the RBI, which has been discussed in the last panel. Nearly 65-68% of the present investing population invests in bank deposits and cash. That's the risk profile of the person. At this moment, we are selling small caps to that risk profile. We'll only get that much. Till we don't, and I'm very happy that that was talked about, hybrid was talked about. I think Radhika is here, and we saw the change that was beginning to happen with Bharat Bond and Target Maturity because we were catering to that risk profile. Everything changed when we stuck our neck out and said mutual fund sahi hai. That was the first time we took an aggressive stand. If we go out and said, yes, debt sahi hai, to debt hamare paas bhi aayega. That's where I think the perception internally has to change. Now the other one is the YouGov data, which says the millennials, some part of millennials is coming to us, but the Gen Z is not coming to us. They are more taking to digital gold, if you believe, and of course F&O and the other products. Are our products suited to them? Is something which we have to. Now when we get caught, it's an internal Mirae thing. We're trying to develop a micro cap thing. Our product is telling, sir, thoda risky hai. Our job is to talk about risk, then leave it to the other person. We should not be judging risk because they are already taking risk. That's where is the perception issue. We have to be more open in our products, and I'm happy the passive side is doing. No, passive is bad. A lot of people tell me that. Industry in 2019 was just 2% in folios in passive. Today it's almost 15% as passive. So we shouldn't be resisting change. We should be accepting change. In fact, playing ahead of change is where my submission is.
Radhika, another perception that the industry has always had is that it chases AUM. In 2018, when SEBI came out with the categorization circular, there was a huge objective being sought to have been met over there, saying that, one scheme per category we'll standardize, how mutual funds look like. So your large cap scheme, my large cap scheme, his large cap scheme should look the same. And there should not be duplicity. After that, there was a small window left in ETFs and index funds and thematic funds and sector funds. And you know how many of those funds have been launched by the industry in the last 3-4 years. So is this perception true, or can the industry do something about it?
I expected a prickly question from you, but this was extra prickly. Well done, Kayezad. Good ball. So does the industry chase AUM? See, every business is in the business of growing, okay? But we are a fiduciary business, so we have a responsibility to grow responsibly. I think a lot of blanket statements, unfortunately, are made. MF industry has a perception problem. I will answer that question later. But I don't think everyone goes out and chases AUM. I give the analogy of a restaurant that if I was in the food business, I would open multiple restaurants. I would launch multiple cuisines. One of us might say, I'm only an Italian restaurant. I know, for instance, Neil launches very few NFOs, very few. We do quite a few. In fact, my sales head is sitting here. I don't think I work him enough. We really do too few NFOs. Some of us make that choice, some of us don't. But I think finally investors have to make the choice, right? Just because a restaurant or a food business is having a launch every week doesn't mean it's okay for your diet.
Radhika, come on. You can't compare a mutual fund to a restaurant.
No, I'm not. I am saying people will do. If a new AMC is launching in the business and they choose to do 5 NFOs, they choose to do 5 NFOs. I think the genuine onus lies on the advisory community who really advises investors that what NFOs make sense and what don't. I also think, I agree with what Swarup says. There are no blanket answers. Not all NFOs are bad. Some NFOs are very good. Some NFOs are very bad. If you ask me as CEO of Edelweiss MF, I am on the side of doing less. I actually believe the industry has enough products right now. If we stopped, this is a controversial statement, if we didn't do a single NFO or create a new category as this industry for 10 years, we would probably do a service to ourselves, because what we would focus on doing is, we have a lot of Legos. We would focus on packaging them and offering them better to our investors. So if all of us did that, would be in good shape? I think so. We have more than enough products. We have everything from an overnight fund to a micro cap product. We have debt products that mature in 2023 to 2037. We have every possible sectoral fund. So genuinely, if we didn't launch a product for the next 10 years, very good. We really should be focused on how people use these products as solutions. You mentioned Dream 11 users. I tweeted a statistic today. We have 40 crore OTT users in this country. We have 30 crore food delivery users. Now, if you can pay for a Netflix subscription, you can start an SIP into a fund. I think if we just focused on pitching products and solving consumer needs, we'd be
there again comes the thing about investor education. How are you going to get the untapped people? And Ganesh, I wanted to get your view on that. Since you are a new AMC and you have quite a lot of presence in smaller towns also, there is this perception about mutual funds that, some distributors and advisors who I was speaking with recently, they say that, once you move out of the big metros, once you even you take a case in Bombay, you move out 150 kilometers outside Bombay, and people are very hesitant to walk into a bank branch and being spoken about on mutual funds. They don't even know mutual funds, one thing, but they don't even want to hear anything about mutual because they feel that, it's an exotic product, it's an elitist product, most of the communication is in English. So that's the least of your problems. Even in Bombay also, even in big cities also, you still have people who have never heard of mutual funds. They invest in chit funds. I'm talking about the labor class, the worker class. So do you have a strategy or do you suggest the industry has a strategy to sort of tap these untapped people?
So I think the scale of the problem is quite immense, Kayezad, right? Today, if you look at it for the mutual fund industry, I would say the B30 cities typically would account for maybe 20-25% of the AUMs, right? if you look at the FD volumes in B30, that's about 65 to 70% of the total FD volumes of the country, right? So it is not that the wealth of India lies only in its cities, right? It is clearly distributed quite well across geographies. So as an industry that is looking to tap into and manage wealth of Indians, I think there is very clearly an opportunity in the B30 markets as well. What is also equally clear is distribution has not yet built up in many of these B30 locations. So the question is, how do you build that distribution? How do you use technology to expand reach beyond, let's say, geographic sort of constraints, right? That is one. And the second is, how do you provide the right kind of propositions, right? See, a lot of people in the B30 locations will need some kind of seasoned advice, but they also need the right kind of products. So, for example, why is it that at the shorter end of the debt products is only catered to institutional segments, right? Why is it that only CFOs should have access to liquid funds? Why is it that overnight funds cannot be used by retail investors, right? Can we have simpler ways by which these kind of products are delivered so that an ordinary person can also have, he has access currently to the same products that a top CFO has in the country, but they're not being used, right? So how do you make that match happen? I think is really the challenge in front of the industry.
That's my question to you. How are you going to do it? When you are going to go to newer towns, how are you going to convert mutual funds from being an elitist product, from a classy product meant for the upper classes or something, and get down to the level of the investor and make them understand this risk and return, not just
I would say that MFs are seen as an elitist product, right? If you look at the ticket size of an SIP, it's probably around 2,500 to 3,000 rupees. So it's not really an elitist product. It's definitely not for the HNIs, and the retail segment is really driving this segment quite extensively, right? So, but I think there is a lot more still that can be done, right? And I think it's really about two things that the industry can probably work on more, which is how do you use technology, right? And there are many ways in which you can use technology to expand your own product set beyond, let's say, physical constraints, right? So how do you have investors invest through different platforms which are enabling them to transact very seamlessly using technology? And the second is, how do you make sure that the communication around the propositions that you have, let's say around liquid or around the other kind of products, are made in a very simple manner, right, to them, so that they are able to transact quite easily.
Is the localization of content happening, in local languages?
Yeah, very much so. It's there's some stats, right, which talk about English news is probably read by only 10% of Indians, right? So if you have to reach out to 90% of Bharat, you have to speak their language, right? So I think it's a given that you need to tailor your content into different languages. Easier said than done, because there are a lot of technical terms as well, and it's not that easy to explain. But I think the onus is on us to declutter the jargon, right, and really make it as simple as possible for people to understand.
Okay, Neil, I want to get your views on trust. That's trust, as Mr. Anand Narayan also said, it's very, very crucial when you're handling public money in a fiduciary capacity. Otherwise, mutual funds have been a very well-regulated instrument, but there is a perception out there about, people who have not known mutual funds the way we have had, saying that, what if it runs away with my money and all. Of course, it doesn't happen because our money lies in a trust and we know how the structure of a mutual fund happens. But there have been, blips in the past for whatever reason, which may have shaken this trust here or there. Specifically, I wanted to ask you, I know that SEBI has been periodically nudged AMFI to sort of look at it as an SRO role. I know that's a very touchy and a controversial topic, and we can have a long debate on that. But do you think that between what SEBI perceives to have been wanting AMFI and the so-called hesitance to become a full-fledged SRO, is there a middle ground where AMFI can, Bala spoke about the ethics committee, but do you think more needs to be done by AMFI to re-establish this trust factor?
So I think more needs to be done with individual fund houses. I think if you want to be an SRO, then we need to regulate ourselves, right? So let me just go back 10 years. So we just finished 10 years of our mutual fund journey. And listen, we've come a long way since that 10 years, I think we're talking about perception problems and all right now here, but we solved for a lot of that. Things have really got better over 10 years. So 10 years back, I remember the couple of reasons why we started the mutual fund was that we were a PMS and a third-party distributor. And a fund house had come to us to sell the products and to tell us to distribute them. And they came with that thicker fact sheet, and all the schemes, they had like more than 100 schemes. They all looked the same, and when we were asking them why this, why not this and all that, and there was no answer to that. So what we thought was the communication was a big gap. Actually, it was non-existent 10 years back. I mean, today, look at all the fund houses. They're communicating amazingly well. So I think that communication has improved and it will continue to improve. I think we all realize that you need to communicate well and transparently with our unit holders. Secondly, obviously regulation has come in with the categorization. So you cannot launch that many schemes. So automatically that has come down. So our thing was that, okay, the perception problem for us was that, okay, there was no communication whatsoever at that point from a mutual fund point. There were too many schemes. It was very confusing. How do we simplify it? And when we asked him, why should we sell this fund other than the other one? They're like, nahin, isme commission zyada mil jayega. So that's also been rationalized with upfront commission going out and expense ratios coming down and commissions being rationalized. So I think we solved for a lot of those things over the last 10 years. And I think the next 10 years are even going to be better. So I'm not worried that we have that much of a perception problem as such. I mean, yes, can we all improve? Yes, collectively we all can improve, become more responsible. But on a general scale, I think we're doing a great job.
But even SEBI chairperson also had said recently that, so far, given the growth of the industry, SEBI has to play a big role. But now, there needs to be an AMFI 2.0 or, there needs to be lesser and lesser involvement of the regulator and more of self-regulatory. So there, do you think AMFI or the industry can do a bit more?
Yes, absolutely. I think we've seen that regulations have tightened over the last few years. And I think regulation will loosen up if we all start acting or behave more responsibly in what the regulator sees. I mean, and that's been the communication from the regulator itself that, listen, we don't want to over-regulate anyone. We would rather have a looser kind of a policy and you all get more responsible. And I think you said, I mean, one thing is that we're still in an early growth stage of the mutual fund industry. I mean, I don't think we're nascent, but we are in the early growth stage and things will get better. I'm pretty confident that we all will start doing better. I mean, couple of things is that, can platforms who are selling cannot flash last 3 months return and make people buy all that? I mean, that's a very easy thing to do. Can banks not have a very aggressive sales target so their salespeople will sell coconut oil or hair oil to a bald person and curb mis-selling? I think those are things that can be solved, and I think we will solve those things when we go forward.
Okay. Kailash, let's pull you in now. You've been quiet for a long time. One big perception which we discussed in the earlier panel also is that, mutual funds don't sell debt funds, and mutual funds don't have debt. They are only equities. How do you fight that perception now that, the tax parity has been achieved across debt instruments?
While it's always nice to talk about equity, I don't completely 100% agree to that statement for two reasons. Yes, we haven't done enough on debt at the retail end, but I think what happens is that if you look at the last 3-4 years, where there was a interest rate cycle expected to go up and it did go up, debt is not the most attractive of instruments, so to say, unless you are a very sophisticated investor, where you can do certain tax planning. I think the moment your rate cuts start is when you start seeing capital appreciation, debt starts becoming a part of the conversation. So if you have a carry or a yield of around 7+ on a bond fund today, and you're looking at 100, 125, 150 basis rate cut over, say, 2.5 years, we don't know that. But suddenly you'll start looking at people saying, oh, this is a great place to be for the amount of risk that you're doing, I think. And we'll see a surge of corporate bond fund, medium-term funds, long bond funds. We saw this in 2016, 17, when the situation was like that. So we did sell it. After that, it kind of tapered off. So I'm not worried about that. I think debt will become a part and parcel. There's one thing I would want to say, most of us who work, okay, or are having even our businesses, the people who work, naturally we have debt because we have a provident fund deduction. Okay, and if you actually take that into account, we are actually more debt heavy than equity heavy in our overall portfolio. Okay, so that's something people miss out on. And similarly, the people who are in business have these fixed deposits, etc. So they are more debt heavy.
No, but
so
then Kailash, see
just hear me out. So hence the conversation around debt. But I can tell you, possibly 9 months or 10 months from today, when the rate cuts start getting announced and more future outlook is positive towards the rate cut, I think there'll be a lot more conversation around debt. And I just wanted to add one because of the topic of 20 crore investors, if you permit me. Pre-COVID, we had half the number of investors that we have today in the industry. Pre-COVID, it's not too far back, like 3 years back. So the rate of growth that we are seeing in the industry in terms of new investors coming, I think the 20 crore is soon to be met.
But I again want to go back to your other point. I think we're running out of time, and I want to ask one question to Radhika before we close the panel. But you said that inherently people already have so much of debt in terms of their PPF, but that the same thing can be said about equity also. Inherently, people also trend to gravitate towards equity markets. So you're not using that excuse to not sell equity funds. So how can you use the excuse of PPF to not sell debt funds to investors?
But if you look at the percentage allocation of debt to equity for most households in India is skewed towards debt. And hence you try and put in more equity to them. So that is why the conversation around equity happens more than debt today. That's the only reason that I'm just bringing to the table. Okay. Nothing more than that.
Okay. Point taken. Radhika, one last question for you. See, today, even in the recent past also, keeping aside your SIP inflows, and today the figure came 16,000 crore a month, so that's a record figure for the mutual funds industry. But other than that, two things I just want to point out. One is that 50% of the money actually goes away out of the mutual fund industry within 2 or 3 years. So the matter of longevity is still not being drilled down to the lowest possible level. And number two is that money also, inflows also come in when the markets are high. That's when the conversations happen. But when the markets are low and in a prolonged bear phase, other than your SIP inflows, people don't really actively put money. So how are you going to change that perception to make mutual fund a genuine long-term asset wealth builder in your portfolio?
And actually, it's good you're ending on that question because that is genuinely the perception that you have to change. I mean, you are saying only SIP. I think the one thing we should be celebrating is that we have a 16,000 crore SIP book. I sometimes get called SIP Wali at airports. I'm not even kidding. And SIP has become a meme. And the reason this is all good news is because if you have an investor who invests via SIP for 10 years, even in a very average fund and the market doesn't do anything, they will not have a bad outcome. So I think the success of SIP is the success of all of us because we are building investors that are sustainable. Now, I think the first question you asked is a very important one. I do believe the market has become more and more short-term. This whole point, I think Neil brought it up about chasing 1 month performance, 3 month performance. I mean, all of us know secretly that if we have a fund that is in the top 1 year in its category, it will get money, even if its name is Radhika is a nice person.
The irony is that where this is happening is in the fintech platforms. And the fintech platforms are the ones that are growing and growing and growing, because it's a cheaper way to sort of set up a mass distribution.
And the reality is, I don't want to single anyone out. I think all of us as fiduciaries are responsible for behavior and driving better behavior if we are stakeholders in this industry. I think Chairperson has also said that we are long-term stakeholders. So we have to, it is very easy to sell what is glamorous, but we have to do the right thing. I think one thing that all of us can do, and media included, Kayezad, is that we have a lot of very short-term conversations about markets. I really think this industry should have more conversations about 5-year views and 10-year outcomes, because when you're giving someone a market view, my team and I were discussing this, you have to give one every 3 months, and then the investor is going to come back to you and say, what changed in 3 months, and, tell me something else. And you're automatically making your investors 3-month investors and 1-year investors. You know, we are very lucky. We have a great product. We sell India. We sell the India story. And we are living in a great decade for India. If we can just focus on that and honestly stop having these short-term market debt and equity views, we'll do we have to role model the behavior we want our investors to be, if we truly want investors to be long-term. And truly, if there's one thing that worries me, it's this curse of 1-year performance.
Okay.
30 seconds on SIP penetration, because we talked of penetration a lot. B30, T30. Normal sales, 80-20 ratio. 80 B30, T30 and 20 B30. SIP, 50-50. Yeah. That shows penetration. So your question is that. So they are doing unfortunately, you know, in tier 4 cities, they say हम म्यूचुअल फंड में निवेश नहीं करते हैं, हम SIP में करते हैं.
And Kayezad, one more stat. You know, one thing that will help is an increase in the population of distribution. There's a study that we did. If you look at the money that stays beyond 2 years in our funds, and I'm sure it's the same across industry, it's 14% for direct, it's 35% for distribution assets. So if we focus on growing the community of distribution and advice, we'll do a long service in keeping people
that's the big challenge in front of the mutual fund industry as to how to grow the distribution.
And this is why we should grow it, because it holds assets for the long term.
Cool. So we'll end it on this note. Thank you so much. And can we have a big round of applause for our second panel? Thank you.